When you see a stock that's up 43% in just 2 weeks, do you see a strong buy, a falling trend just waiting to happen, or, I don't know, a hidden gem that's actually undervalued?
I mean, it is the ultimate Rorschach test for traders right now.
Right.
What you see on that chart says a lot more about your own investing philosophy than it does about the company itself, honestly.
Yeah. And today, we are going to crack open their financials to find out what it really is. But first, the price of admission to today's deep dive is simple.
Just a quick click.
Exactly. Take a second to hit that like button, subscribe to our YouTube channel, and tell us in the comments if you think the stock we're covering today is a trap or a treasure. It's compulsory if you want to keep getting these breakdowns, and it really helps us out tremendously.
It does.
So let's get into the footprints. Our mission today is squarely focused on Quantum Computing Inc. The ticker is QUBT. We are, ripping open their latest financial statements, dissecting the highly conflicted technical signals flashing on their chart, and tracking exactly what the insiders are doing with their own money.
But before we put those numbers under the microscope, I just want to clearly state that everything we discussed today is strictly for educational purposes.
Absolutely.
We are just looking at the raw data, spotting the market patterns, and having a natural human debate about the underlying mechanics. This is absolutely not financial advice.
Definitely not. But we need to debate this because the tension surrounding QUBT right now is just palpable. I mean, the company is currently in this massive momentum phase, but the underlying data is giving off incredibly conflicting
Oh,
signals.
totally. Retail traders are completely split.
Right. Half the internet thinks this is the next big tech play, like the ultimate ground floor opportunity to get in on quantum computing.
And the other half.
The other half is screaming that it is a highly engineered, very dangerous value trap that is going to leave retail investors holding the bag. So to figure out what this company is actually worth, we have to start by looking at what the stock price is doing mechanically right now.
Yeah, because price action is the physical footprint of market psychology. And the footprint QUBT is leaving right now is, well, it's moving at a breakneck pace.
It really is.
We are looking at a closing price of $9.83 on April 20th, 2026. That was a 2.72% gain on the day, which marks its 7th consecutive day of growth.
7 days straight of green. I mean, zoom out a little, and it is up 43% in 2 weeks.
It's a massive move.
That is a staggering short-term move, especially when you look at the broader context of where the stock has been. The 52-week range swings all the way from $5.76 down at the bottom up to $25.84 at its peak.
Right. And right now, at that $9.83 level, the market is pricing the entire company at $2.21 billion.
Which is wild, and the technical momentum indicators are just screaming bullish. Like, let's look at the MACD.
Yeah, the MACD is key here.
It's sitting at a positive 0.432, showing sustained momentum since, I think, March 31st.
Yeah. And for anyone wondering what that number actually tells us mechanically, the MACD, the moving average divergent, it basically measures the relationship between two moving averages of a stock's price.
Okay, so like a comparison.
Exactly. Think of it as comparing what the stock is doing this week versus what it's been doing over, say, the past month. When the short-term trend violently crosses above the long-term trend and pulls away, the MACD goes positive.
So a positive 0.432 means?
It means the short-term buying pressure is heavily outpacing the historical baseline. Institutional algorithms look at that and see a confirmed uptrend.
And it's cleared some major physical hurdles on the chart, too. I mean, it is currently sitting above its 50-day simple moving average of $8.16.
Which is a huge signal.
Right. That is traditionally a strong buy signal for momentum traders looking for a breakout. It is also comfortably above its 200-day moving average at $7.39.
Yeah, which acts as that long-term psychological support floor. So the trend direction is undeniably bullish in the short term. We are seeing order flow concentrate around key support levels.
Meaning there's a safety net.
Exactly. There is heavy accumulated volume acting as a safety net at $9.44 and a secondary deeper support at $8.67.
Okay, so that's the good news.
But, and there is a very significant but here, it's currently testing immediate resistance right around $9.56. If it breaks that, the next major battleground zone isn't until $12.56.
Okay, here's where it gets really interesting and honestly terrifying if you're buying today. If you look at the RSI, the Relative Strength Index, over a 14-day period, it is sitting at 90.
That is extremely high.
Yeah, I was trying to think of how to visualize an RSI of 90. And it's like, imagine a sprinter who just ran a 400-meter dash at absolute top speed.
Oh, I like that.
To the crowd in the stands, they look incredibly fast. They are winning the race. Everyone is cheering, but internally, their heart rate is maxed out, their lungs are burning, and they are completely out of breath.
Right.
They are due for a sudden, aggressive stop because you just can't sustain that level of output.
That analogy perfectly captures the mechanics of the RSI. I mean, a stock can be undeniably bullish, yet simultaneously exhausted.
Exactly.
The RSI measures the speed and magnitude of recent price changes on a scale of 0 to 100. Anything over 70 is traditionally considered overbought.
So 90th.
At 90, the technical rubber band is stretched to its absolute physical limit. A snapback, a short-term pullback just to let the stock catch its breath, becomes a statistical probability.
And there is a massive hidden warning sign in the chart backing that up, right?
Yeah.
Volume divergence.
It's the warning sign everyone ignores when they have FOMO.
Explain how volume divergence actually works behind the scenes for this.
Well, we are seeing falling trading volume even as the price continues to push higher.
Which shouldn't happen.
Right. When a stock is making new local highs, you want to see rising volume. That confirms the broader market, especially institutional money, believes in the move and is actively buying in.
So when the price goes up but the volume goes down,
It means the rally is losing its structural integrity. The big money has stopped buying. The only people pushing the price up are late-to-the-party retail traders.
oh man, they see 7 days of green, they fear missing out on the next big run, and they buy at the absolute top of the momentum wave.
And then the exhaustion sets in. The institutional algorithms trigger their profit-taking protocols, the volume dries up completely, and the stock corrects violently.
This is exactly how retail traders get trapped.
Yep.
So if the stock is running like our exhausted sprinter, what kind of financial engine is actually powering it? Because when you open up their latest financials, the fiscal year 2025 summary that dropped on March 2nd, 2026, the numbers just don't seem to belong to a $2 billion company.
They absolutely do not. Let's dig into the income statement.
Okay, so annual revenue for 2025 was $682,000. Now, that is technically up from $373,000 in 2024, but let's just pause and appreciate the absurdity here.
It's pretty well.
We're looking at a $2.2 billion company that essentially makes the annual revenue of a moderately successful local restaurant.
I mean, it is a profound disconnect between current fundamentals and market valuation. They generated under $1 million in sales for an entire fiscal year.
And their losses.
Right. To produce that minimal revenue, their net loss was $18.67 million, which translates to an earnings per share, or EPS, of negative 11 cents.
Wait, hold on. I need to push back on that net loss figure. Because on paper, a loss of $18.67 million looks like a massive improvement from their negative $68.5 million loss in 2024.
It does look like that, yeah.
But they didn't magically cut $50 million in operational costs, did they?
No, they didn't suddenly become wildly efficient at selling quantum computing services.
Yeah.
That $50 million improvement is basically an accounting illusion.
Really?
Yeah, the improvement was largely driven by something called non-cash derivative gains.
Okay, you cannot just gloss over non-cash derivative gains. That sounds like Wall Street magic. What is actually happening there?
Fair enough, let's break that down. When a company issues certain complex financial instruments like stock warrants, those instruments are recorded as liabilities on the balance sheet.
Because they might have to pay out.
Exactly. A warrant gives someone the right to buy stock at a certain price. Now, if the company's actual stock price drops, the theoretical value of those warrants also drops.
Right, they become less valuable.
And because that liability went down, accounting rules actually allow the company to record the difference as a gain on their income statement.
But no actual cash entered the building?
Not a single cent. It's entirely paper profit based on the fluctuating value of their own financial instruments.
Wow.
Yeah. If you want to know how the actual business is doing, you have to look at cash flow. And their net operating cash flow remains deeply negative.
How negative?
Just in the fourth quarter of 2025 alone, their free cash flow was roughly negative $12.17 million. They are burning cash just to keep the lights on and the laboratories running.
So how does a company burning $12 million a quarter, making restaurant-level revenue, sustain a $2.2 billion market cap without going bankrupt?
The answer lies entirely on the balance sheet. This is the billion-dollar paradox of QUBT. Their total assets sit at an incredible $1.62 billion.
$1.62 billion in assets.
Yeah. And the vast majority of that isn't just goodwill or, like, theoretical intellectual property.
Yeah.
They have $737.9 million in cold, hard cash and cash equivalents.
Wait, if they are burning cash every quarter, how did they accumulate $750 million in cash? They certainly didn't earn it.
Yo, they raised it. They raised it through massive private placements throughout 2025.
Ah, I see.
Institutional investors just poured capital into the company in exchange for equity. Because of that massive influx of institutional money, their balance sheet is an absolute fortress right now. They only have $20.66 million in total liabilities.
That's nothing.
Exactly. When you subtract the liabilities from the assets, you are left with $1.6 billion in pure equity.
They owe practically nothing compared to what they hold in the bank.
Right, so the market isn't valuing them based on the $0 they made yesterday. Investors are looking at a company with the sheer financial firepower to survive the agonizingly long R&D cycles required in quantum computing.
They bought themselves time.
Yes, they've insulated themselves from the constant threat of insolvency.
So because traditional valuation models don't work here, I mean, you can't do a standard price-to-earnings ratio on a company with no earnings. We have to look at how Wall Street algorithms and human insiders are actually pricing this stock.
And the math out there is incredibly polarized right now.
Oh, completely.
The analyst consensus across 6 major Wall Street analysts is currently a buy, with an average price target of $17.50.
Which implies massive upside from the $9.83 it's trading at now.
Yeah, you have firms like Northland Capital Markets initiating coverage with an outperform rating and a massive $20 price target just recently on April 20th.
But not everyone agrees.
No. On the flip side, Cantor Fitzgerald recently downgraded their target from $15 down to $10, moving to a neutral or hold stance. But the real divide, honestly, is in the algorithmic models.
It is the definition of a split personality. Like Guru Focus, which is famous for its strict value investing metrics, claims the stock is vastly overvalued.
Very overvalued. They
They estimate its true intrinsic value is a microscopic $1.27, meaning at almost $10 a share, it's trading at a 667% premium.
Right.
But then forward-looking models suggest it is deeply undervalued, giving it a fair value of $23.67. How can two computers look at the exact same company and be $22 apart?
Well, the Guru Focus model is looking backward at historical cash flows. It asks how much actual cash is coming in the door today.
And as we established, that's practically zero.
Right, so the value model aggressively punishes them for that. The $23.67 fair value models, however, are looking entirely at the horizon. They are baking in a projected 3,600% growth rate in 2026.
That is a staggering number.
It is. They are pricing in the future commercialization of quantum computing as if it's already a mathematical certainty.
Okay, but if this company is supposedly on the verge of 3,600% growth, I have a massive problem with the insider activity.
Insider trades.
I was tracking the insider trades over the last 6 months, and they have been net sellers, offloading $60.6 million in the last year alone.
That's a lot of selling.
And let's look specifically at the chief financial officer, Christopher Roberts. He sold about $540,000 worth of stock in March 2026 at $7.85 a share.
Yeah.
If you are the CFO, the guy who literally controls a ledger, and you supposedly know the company is about to explode 3,600%, why are you bailing out and cashing out $500,000 at $7.85 just weeks before this recent rally pushed it toward $10?
That is the ultimate red flag for retail investors. I mean, insider selling is notoriously difficult to decode because executives sell for totally mundane reasons all the time: tax obligations, buying real estate, simple portfolio diversification.
Sure, they need cash, too.
But the mechanism of when they sell really matters. Selling significant volume just before a massive retail rally suggests the CFO viewed $7.85 as a fair, fully valued exit point.
Wow.
It signals that he doesn't believe the near-term catalysts justify holding out for those 23.3 price targets.
It completely undermines the narrative of impending explosive growth.
It does. Though, to balance the scales, we do have to look at how compensation structures work. The company's directors recently received $750,000 in stock awards at $6.78 share in mid-April.
Okay, so they are getting more stock.
Yeah, and institutional algorithms see those awards and interpret them as executives keeping their skin in the game. But from a purely psychological standpoint, the CFO actively dumping shares on the open market carries much more weight than directors receiving automated stock grants.
Definitely. So we have a terrifying stock chart with an exhausted RSI mixed with a basically bulletproof balance sheet.
Yep.
If I'm an investor looking at this, what is the catalyst that actually triggers that 3,600% growth everyone is whispering about? What is the ultimate bull versus bear debate here?
So the bull case rests heavily on survival power and a massive industry halo effect. First, that $1.6 billion in cash. In deep tech, cash is oxygen.
Because things take so long to build.
Exactly. Having that liquidity means QUBT can engage in aggressive mergers and acquisitions or sustain heavy internal R&D without having to issue new shares and dilute the current stockholders.
And what about this halo effect? Because it seems like they are catching a massive tailwind from Nvidia, a company they aren't even directly partnered with.
Yeah, this is the most crucial piece of the puzzle. When Nvidia recently launched their Ising AI models, it just ignited the entire quantum hardware sector.
Okay, stop right there. You just used Ising models and quantum hardware in the same breath. We need to translate that into plain English.
Sure enough.
What is Nvidia actually doing, and why does QUBT care?
Okay, imagine you are standing in a massive, complex, hilly landscape in the dark, and you need to find the absolute lowest valley. A classical computer searches by walking up and down every single hill, one by one. It takes forever. Quantum annealing, which is the architecture QUBT works with, is like flooding the entire landscape with water and letting gravity pull it to the lowest point instantly.
Oh, wow. That's a great way to think about it.
Right. It looks at all possibilities at once to solve incredibly complex optimization problems. Nvidia's new Ising models are essentially the software instructions designed specifically for that kind of water flooding problem solving.
So Nvidia just announced to the world that optimization software is the future of AI.
Exactly. And investors immediately flooded into pure play quantum hardware stocks like QVT. It's the classic gold rush analogy.
Everyone wants to sell the shovels.
Yes. Nvidia is telling everyone where the gold is, and investors are betting that QUBT is going to be the company building the physical pickaxes, the actual quantum hardware needed to mine it.
It's a proximity play. They go up just by being in the same neighborhood as Nvidia's new tech.
Basically, yeah. Plus, QBT does have tangible business moves they're on. They closed the integration of Luminar Semiconductor back in February 2026.
Oh, right.
And bulls are expecting that acquisition to be a major driver for actual concrete revenue in Q1 2026, hopefully pulling them out of that sub-$1 million restaurant revenue phase.
So the Luminar integration is the bridge the bulls believe will finally connect their massive cash reserves to actual commercial viability.
Exactly.
But what about the bear case? If things go wrong, what is the mechanism that pulls this whole thing down?
Well, the bear case focuses heavily on structural volatility. We mentioned the technical fatigue with the RSI of 90, but the volatility is built into the DNA of the stock itself. QUBT has a beta of 3.67.
For the listener who maybe doesn't stare at risk metrics all day, what does a beta of 3.67 actually do to their portfolio?
So beta measures a stock's volatility relative to the overall market, usually the S&P 500. The broader market operates on a baseline beta of 1.0. A beta of 3.67 means QUBT is historically nearly 4 times as violent in its price swings as the rest of the market. If the S&P 500 drops 1% on bad macroeconomic news, QUBT is statistically engineered to crash 3.67%.
Wait, if they have $750 million in cold hard cash, shouldn't that insulate them from that kind of extreme market swing? Why is the stock still so fragile?
Because that cash isn't generating yield, and their actual revenue is virtually non-existent. The entire valuation of $2.2 billion is built on sentiment and future promises.
And sentiment can change fast.
Very fast. If a macroeconomic shock hits the market and investors suddenly demand profitability today instead of promises for 2030, sentiment evaporates.
Right.
And because they only make $682,000 a year, there is no fundamental revenue floor to catch the falling knife. The cash in the bank keeps the company from going bankrupt, sure, but it doesn't keep the stock price from plummeting.
So you're basically choosing between a brilliant balance sheet and a terrifying, highly volatile stock chart.
Yeah, I mean, the short-term outlook is incredibly dangerous due to the technical exhaustion. Buying today at an RSI of 90 is literally fighting the laws of market physics.
But long-term.
But the long-term outlook reveals a company that is exceptionally well-funded, sitting on a mountain of cash, and positioned perfectly to sell the pickaxes for Nvidia's new AI gold rush.
So to recap this massive tension, we have a heavily funded quantum company riding an undeniable wave of Nvidia-adjacent AI hype. They have the cash to survive for years without diluting shareholders.
Right.
But they're completely hampered by a lack of current real-world revenue, an insider selling problem with their CFO, and a technical chart that is screaming for an immediate, painful pullback.
It is the defining battle between what a company could revolutionize in the next decade and what the stock is mathematically doomed to do in the next 2 weeks.
Which leaves us with a pretty profound question to wrap things up. If a company with $1.6 billion in assets, three-quarters of a billion in cash, and some of the smartest quantum minds in the sector can still only manage to generate $682,000 in actual revenue today, the real question isn't whether quantum computing is the future. We all know that technology is coming.
It's definitely coming.
The real question is whether retail investors can afford to tie up their capital and wait long enough for that future to actually arrive.
That is the true cost of investing in deep tech. You aren't just paying with your capital. You are paying in years of your time.
A lot of time, with a lot of volatility along the way. And on that note, we'd love to know what you think. Is QUBT a value trap waiting to spring on exhausted retail traders? Or is it a hidden treasure chest just waiting for the right hardware catalyst? Let us know down in the comments. And remember, subscribe to the channel and like the video so we can keep bringing you these deep dives. Until next time, keep questioning the numbers.